Hello everyone, and welcome back to the channel where we demystify the complex world of hard-to-borrow stocks and potential short squeezes. Today, we're diving deep into a fascinating microcap that's been lighting up our screens due to some truly extreme borrow market dynamics, CLRO. We'll break down exactly what's happening under the surface with CLRO, why it's become so hard to short, and what that could mean. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Just CLRO ticker and basic stats on screen. Let's zoom in on CLRO. This is a microcap company, meaning it has a very small market capitalization, often associated with high volatility and lower liquidity. Regarding its recent trading activity, CLRO has been notably quiet. Show price chart over the last 5 days, and even the last 30 days, the stock has seen a 0.0% change in price. Today's change is also sitting at 0.0%. Similarly, volume has been almost non-existent. Today's volume is 0 shares, with a 30-day average volume of 0 shares, giving it a relative volume of 0x average. This tells us there's currently very little actual trading happening on the exchange for CLRO. What is cost to borrow and why it matters. But here's where it gets interesting, because the borrow market is a different story. To understand what we're seeing with CLRO, you need to understand cost to borrow or CTB. To animation, short seller borrowing shares from broker. When a short seller wants to bet against a stock, they borrow shares, sell them, and hope to buy them back later at a lower price. But borrowing shares isn't free. Brokers charge a fee, known as the cost to borrow. This fee is typically expressed as an annualized percentage. Think of it like interest on a loan. The higher this fee, the more expensive and potentially risky it is to hold a short position. When this fee gets extremely high, often exceeding 100% or even several 100% annually, it signals intense demand to short the stock, coupled with a severely limited supply of shares available to borrow. This is why CTB matters. It's a direct indicator of shorting pressure versus borrowable supply. Why this stock is hard to borrow right now. Now let's apply this to CLRO. Show CLRO CTB data. The cost to borrow fee for CLRO right now is an astonishing 720.4% annualized. That's not a typo. Short sellers are paying over 700% per year just to hold their short positions. But it gets even more extreme. Over the last 5 trading days, the CTB has surged, increasing by an incredible 806 percentage points. This indicates rapidly escalating pressure in the borrow market. Why? Because the supply of shares available to borrow is critically low. A mere 100 shares are currently available to short. Think about that, only 100 shares versus an estimated float of 0.7 million shares. Our internal composite squeeze score, which factors in CTB, borrow momentum, shrinking supply, float size, and technicals, currently gives CLRO a score of 50.6. This is a solid, mid-range score, indicating several key factors for a potential squeeze are aligning. However, it's crucial to remember that a high cost to borrow, while a strong indicator of demand from short sellers and limited supply, does not automatically guarantee a squeeze. It could also mean short sellers have incredibly strong conviction and are willing to pay almost any price to stay short. Squeeze mechanics explained. So, what is a short squeeze and how does a situation like CLRO's factor in? Show animation, short sellers buying back shares, price rising. A short squeeze occurs when a stock's price starts to rise, forcing short sellers to buy back the shares they borrowed to limit their losses. This buying action, in turn, pushes the price even higher, triggering more short sellers to cover, creating a rapid upward spiral. With CLRO, the fact that only 100 shares are available to borrow, against an estimated float of 0.7 million, means that even a small amount of buying pressure could quickly create a severe supply shock for short sellers who need to cover. If they're paying 720.4% annually, their motivation to cover quickly to stop the bleeding will be extremely high if the price starts to move against them. Dilution risk check. Before we get too excited, let's address a critical risk for CLRO, dilution. Short text dilution risk. CLRO or checks show a significant dilution risk flagged for CLRO. Recent SEC filings indicate a registration statement specifically in SMINS1, SMINS3, or 424B within the last 90 days. What does this mean? A registration statement typically signals a company's intent to issue new shares to the public. If CLRO were to issue a substantial number of new shares, it would increase the total number of shares outstanding, effectively diluting the value of existing shares. Even if the cost to borrow is sky high and short sellers are panicking, new shares flooding the market can provide an easy supply for them to cover their positions without having to buy from the open market, or simply depress the share price, offsetting or completely negating any potential short squeeze. On a separate note, we did check for a reverse split for CLRO in our look-back window, and no recent reverse split was found. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. So, for CLRO, you have a situation where the borrow market is screaming hard to borrow with its 720.4% CTB and only 100 shares available. But you also have zero volume and 0% price movement, indicating very little actual trading activity. The key for CLRO, if any squeeze potential were to materialize, would be a sudden increase in genuine buying volume. Without that buying pressure, short sellers, despite their high costs, might simply hold their positions if they have strong conviction in the company's future prospects. The extreme liquidity combined with the tiny borrowable supply could lead to rapid, exaggerated moves if volume does pick up. But remember that significant dilution risk. This potential for new shares is a powerful counterforce that could cap or entirely undermine any upward movement driven by short covering. CLRO presents a fascinating case study in the dynamics of hard-to-borrow stocks. While the borrow market signals are incredibly strong, with CTB over 700% and virtually no shares available, the current lack of trading volume and the significant dilution risk introduced by recent SEC filings mean this is a complex situation. Always remember that high CTB is an indicator, not a guarantee. We're here to educate you on these mechanics so you can identify and analyze these situations yourself. If you found this breakdown helpful, please hit that like button, subscribe for more insights into the borrow market, and let us know in the comments if you have any questions or other stocks you'd like us to analyze. Thanks for watching, and we'll see you in the next video.